So the BLS just released their latest inflation report only about half hour ago, and I just got done reading through it and putting together some graphics, and this is not good. This is not good. So let's break down this new data, how it works, and why this matters to everyone, both if you're an investor or not. It's arguably worse if you're not an investor. So let's talk about this, how this affects you in the data that just came out. So the data that just came out is the CPI data. Now this comes out monthly from the BLS. The CPI measures the changes in prices consumers pay for products or services on a monthly basis. It basically tells us how much more expensive the things that we purchase on a daily basis are getting. They look at tons of different categories in many different metro areas. Now, some people say that the CPI is rigged or it's not perfect. It's not perfect, but at least it gives us an idea as to where things are trending. Basically, it tells us, is inflation getting out of control or not on a monthly basis? And this is of particular concern right now because the CPI increased 5% year over year last month in May when those reports came out. And that was the largest increase in nearly 13 years. So with all the money that's been pumped in the economy with stimulus, we were kind of sitting on this tipping point like, okay, that was the worst that we saw in 13 years. Is next month going to be better? Is it worse? It gives us an indication as to what's going to happen next. And it's worse. It's worse than I thought. So let's go over to the report. First off, I have to admit that I was wrong. I talked about this a little bit yesterday. I thought that inflation was going to go down. I thought we were going to see the report go down slightly, maybe like 10%, a 10% smaller increase in June over May. I was wrong. The opposite, in fact. So we can see in May, the CPI increased 0.6%, but in June, it increased 0.9% in 1 month. 50% more increase in 1 month. That is just insanity to me. This is the largest 1 month change since June 2008 when the index rose 1%. So we're right there with June 2008. Over the last 12 months, all items on the index increased 5.4%. So we jumped up from 5.0% from the May to May basis, and now 5.4% from June 2020 to June 2021. Absolutely crazy. And I mean, not where the opposite trend of where we want to be and not what I expected. What was especially crazy here is the used cars and trucks continued. They actually jumped up even more dramatically, increasing 10.5% in June. This is especially nuts to me because 3 months ago, the used car and truck category jumped up 10%. Then the month after that, jumped up about 7%. Now up another 10%. What's especially fascinating really about this is the larger a number goes up, the harder it is to push it up by the same percentage point. So if you have like 100 of something jumping up 10%, now you have 110. To jump up another 10%, you have to increase it by 11, not by 10. So it's harder to increase more, but I mean, they did it. The food index increased 0.8% in June, doubling what May was. The energy index is another one of those that helped push the entire CPI up 1.5%, with the gasoline index raising 2.5% in a single month. Now I highlighted some of the larger items here. Food at home up 0.8%, energy 1.5%, used cars and trucks, we talked about that, 10.5%, transportation services up 1.5%. There was a little bit on transportation services here that I thought was kind of fascinating. The index for used cars and trucks increased 42.5% in the last 12 months. Wow. If you have a used car sitting in your garage that you don't use, I guess now is the time to sell that. Unfortunately, the full comprehensive PDF with every single item they look at hasn't come out yet, because we were talking about this yesterday. Let's see. You can see the price of bacon, the bacon index, if you will. It was up 13% in the last year. So I'm going to be checking in to see what the bacon index is at once this actual PDF comes out, because we just have this preliminary data so far. So let's break this down a little bit further, hop over to the iPad and get myself over here. All right, so this is what's happening. It's called demand pull inflation. This is why we're seeing this inflation go up. You might be wondering, like, okay, I understand that there's more money in the economy, but how does this relate to everything getting more expensive? And that's what's happening here, demand pull inflation. Now, of course, these concepts are much more complex than what I'm going to break down here. This is a simplified version, but at least give you an idea as to what is going on. So with demand pull inflation, basically what's happening is the money supply is increasing, which increases demand. People have more money, they want to buy more stuff. And then in the short run, businesses can't satisfy that demand. They simply can't produce much more on the short run. You know, it takes a while to build something like a manufacturing facility, have new businesses start. Those kinds of things take a while. So the only place that price can go is up. So we can see here on the left side, we have the price on this axis and then real GDP on the bottom. Now, real GDP is different than just GDP. Real GDP is how much is actually produced, like the value that is produced. So we have the supply line here. We can see DO, the first demand level with this blue dotted line. And then the supply of money goes up, demand goes up, but the only place for price to go is up. And that's exactly what we're seeing. Now, some people think that this is a temporary thing, that, you know, manufacturing will catch up to the level of demand, things will even out and we'll be okay. Some people think the opposite. So let's break this down even further as to how the money supply and the GDP are related here. So why does this happen? Here's economy 0. So we have a GDP of $500 in economy 0. And that's calculated by the money supply of $100, so basically the amount of money in the economy, and then the velocity of money is 5 in this example. The velocity of money is how many times the same dollar is used on final transactions. So if you spend $1 at the grocery store spends $1 at a supplier, and the money stops there, that'd be a velocity of money of 2. So in this case, this healthy economy, we're saying the velocity of money is 5, the money supply is $100, so the total GDP is $500. Now, the economy slows down. Something like a pandemic happens and people are spending less. So the velocity of money cuts in half to 2.5, but we still have the same supply of money. But this just means our GDP is now half of what it used to be. Now it's $250 as compared to the GDP of $500, which actually can lead to deflation. And we saw a month or maybe 2 last year of deflation. And then what happened, at least in the case of the pandemic, is the government steps in, adds money to the money supply. So in this example, we're just going to say that the government doubles the money supply now to $200. So it was $100, now it's $200. What happens here, now this is economy 1.1, what happens here is the money supply now doubled. The velocity of money is still low because the economy is hurting right now, so it's still 2.5, but you multiply 200 by 2.5, you get the original economy size of $500. So it seems healthy. It's kind of like a fake healthy economy because the money's there, but less is actually being produced. And then here's what happens when the economy starts to heal and things start to get better. The velocity of money starts bumping up. You know, people start going outside and start spending money. Economy 2, the velocity of money goes back up to 5, the original velocity of money. Now the money supply is that same double level. So then the economy size doubles, but there's actually the same amount being produced. So the GDP is going up, but the real GDP is the same. So there's more money out there, but the same amount being produced. And that's when we see this rampant inflation and run into issues here and concerns of the dollar being devalued. Now, I know a lot of people watching this are probably investors, maybe some not. And this is not good for investors. It's hard to hedge against inflation. I mean, you can buy stocks, you can buy real estate, you can buy commodities, and that's about the best that you can do. But you don't want inflation. You don't want your dollar to devalue. You don't want companies to make less profits because they're having to spend more on the cost to make that supply or the service that they're offering. But I'd like to argue that this is actually even worse for the poorest of poor people who don't have assets, because the best hedge against inflation is having assets, because we know the assets are at least somewhat going to appreciate with the dollar going up. If you don't have assets, what do you have? Because wages don't always increase in line with inflation. And if they do, they tend to drag far after. So if inflation goes up 6% in a year, but your wages go up 0.5%, your buying power goes down dramatically if that's all you have, if you have no assets. So this is especially bad for people who don't have money in the first place. People with assets, they're going to be fine. You know, maybe they'll run into short run issues. Maybe some of their companies are going to make a little bit less, quarterly profits for a few quarters. They'll eventually, raise prices and it'll be fine. But that's passed on to the end consumer. And many end consumers don't have assets. And that's why this is a huge concern. because wages don't stay in line historically with this kind of thing. It just means less buying power. Everything is going to get more expensive. And that's where this is a huge, huge concern. So now from here, we're going to wait and see how the Fed reacts, if they're going to bump up their targets as to when they start increasing interest rates, because what that does is less money will be circulating. It'll be harder to lend, more expensive to lend. It'll slow the economy a little bit and at least help with inflation. It's not, again, that's not perfect either, but that's one way to react. We don't know if that's going to happen. They have said that they have no plans of doing that. So any drastic move like that is unlikely. Also have to keep an eye to see how the crypto market reacts and how the stock market reacts, because these things can be a little bit touch and go. So that's the data that we have this morning. If you appreciate that, just give this video a like. Check out the various offers linked down below for things like free stocks, free cryptos. I have a couple awesome courses linked down below as well if you want to start a successful YouTube channel or start a moving company like I do and run from Puerto Rico. It's pretty cool. Check those out linked below. I'd like to thank you so much for watching, and I hope you have a profitable day.